How did last Friday's surprise 50-pointer by the RBI change the narrative for Indian equities for you?
Oh, they have delivered a bazooka for us, which people was generally looking forward for. You got during the GFC, you got that bazooka during the COVID. Now you're getting that bazooka again. So I do believe it will lead to a lot of support for Indian medium-term growth to come, not only in terms of GDP, but also in terms of earning growth too. In an environment where you're having a lower inflation, plus now liquidity will go further higher after the 100 basis point CRR cut, plus falling rate, which means it will reciprocate it into the lower auto loan rate, lower mortgage loan rate. So you are entering into a kind of a Goldilocks monetary easing kind of a scenario, which will show up in a 6-month time when you will look at earning growth and other GDP growth prints.
And there was a clear aim here by the RBI to really speed up credit and credit velocity. So are the banks a good place to be?
I'll say banks, NBFCs, consumption, auto, it will be a broad-based benefit. The reason why you have seen such a big bazooka coming out, because neither borrowers were literally coming out to borrow more because the monetary transmission was not happening, nor you can say that banks were also lending. They were also parking the excess liquidity and money outside. But now with that happening and your mortgage and auto loans and other financing rate coming down over there, entire ecosystem will benefit. Banks have been the first beneficiary because people have to play through that, but NBFCs, your auto loan markets, as well your consumption, durables item, white good, anything which is linked to a leverage and stuff, secured, unsecured, will benefit on that one.
Is there a better value proposition to be had in the consumption story and the broader proxies of the global economy as opposed to IT services, which is more export focused?
Oh, definitely. And like right now, if you look at the value space in India, financials classify under that because they are trading close to 18% discount to long-term average on a price to earnings basis. And anything that can offer you a potential higher growth plus trading at a cheap valuation, it's an oasis in desert. That's what your banks and financials are offering you. But I agree with Sean, what he's highlighting. India is moving towards more from exports to a consumption-based market, and the other way around we are seeing we are moving from urban-based consumption to rural consumption, and we do believe we are at a cusp of start of a rural recovery, and it will keep on gaining momentum.
You can't argue with the secular growth story in India and growth well in excess of 6%, but the perception amongst global investors is India is richly valued, notwithstanding last year's drawdown in the markets. Where do valuations stand?
Valuations right now in the range of around 21 to 22, and we do believe it can remain in this territory because of led by two factors. One, definitely led by the policy easing. Whenever the policy easings happen, it led to a valuation re-rating in system, which we are already seeing. And the second factor is positioning. Remember, we are going into this year where all the three based investors like Asia, EM and Global were running a huge underweight on India. It's now they are now catching up post February, end February onward, where India has started outperforming Asia, emerging market, and their other country peers also. Taking that into account, valuation can command premium and can trade at this level at longer. And on a lighter note, you can't buy gold at a price of copper. India is gold. You need to pay price for that.
And that a really interesting global perspective there, Rajiv. And so would you say that this buy India, sell China narrative is intact, or is that stretching it a bit?
It will be a stretch. We are, with the dollar going down, you are visiting a scenario where at one point of time, maybe a year or two, you will see a seller strikes in emerging market, where you don't need to choose between India or China. You will need to choose between EM and DM. And JPMorgan has upgraded emerging markets to overweight after a long time overall. So I believe growth guys may go and sit in India, and the value seekers are going to go in China. So both the countries will benefit.
IT services, pharma, globally exposed, really seem to be at the sharp end of the entire tariff narrative. How selective should we be in terms of how cautiously we should approach those two sectors?
Oh, very, very selective you have to be. You have to position yourself 100% into domestic pharma names or a domestic supporting IT name with very less exposure to global markets or to the US market per se. Definitely it is not a recession in the US, but it's not an exceptionalism also. So slowdown means you will see earnings and everything can get hit hard, which means the 24, 25p trading IT sector could be underwater, and we have downgraded IT services sector to underweight almost a couple of weeks back. And remember, there are structural concerns coming off AI. With the way which AI is getting implemented, is India fully prepared for that? Currently, we don't have an answer of that one. You are going into a phase of a disruption. And when that usually comes, valuation should be near -1 standard deviation territory rather than even at an average also.
Trade deal, US-India, we're still waiting for some clarity on that, but there is a sense that we are moving slowly towards a conclusion in stages, maybe an interim deal in early August or late July, and maybe a conclusive deal by Diwali, mid-October, late October. Is that the way that you're seeing it, Rajiv? And how much of a driver is this going to be in terms of a positive catalyst for the market?
It's difficult to point whether it will be one full bullet kind of a deal happening or either in June or in Diwali, but yet it's fair to assume it can happen in tranches,
yes,
where it been agreed upon on certain and then moved upon to the next issue. But whenever the first tranche will arrive, market will start to pricing in that the next coming 2 or 3 tranches are also given as such. It is very important to happen before July 9th. Remember, right now we are enjoying a 20% arbitrage on tariff versus China. And this is supporting our mobile, electronics, all the market where we are exporting to the US. If the 26% reciprocal tariff arrives, it will be very disadvantageous to India, and market is not ready or pricing in that already when you are trading at 21, 22 multiple. So it is very important to sustain this valuation at this level for deal to happen before July 9th, or we don't need to see that 26% tariff arriving for us over there. But yeah, like right now, things are still fluid. We are still seeing the conversation is not just on with India, but even with Israel, Korea, Japan. So post-UK, there are too many conversations going on, and I hope something will fall soon. And that's what is our base case, that you may see it's happening in tranches.
Do you like the AI story as it applies to the market? And let me bring in commercial real estate and the property developers, because it's at a nascent stage, but there's potentially explosive growth here. We've spoken to a lot of real estate investment trusts and property developers who are looking at data center build out as the next stage. Do you like that space?
Yeah, we are overweight on real estate, not just using an angle of AI, the data center build-up, which we have seen happening in our neighborhood in ASEAN region. How the data center story played out for your construction companies, for your conglomerate property guys. A same story going to happen in India also, because they are just entering into that particular phase. So that story usually stays for at least 18 to 24 months time period. We are just entering into it, so you have a headroom. It's difficult to figure out right now that who are the key players and developers who will be operating in that space. But besides that, rate cut story, don't forget, because if your mortgage rates are heading towards the 7 handle in India,
exactly,
that will give you another boost. And remember, India's rising GDP per capita plus rising income of the middle class, especially post the tax rate cuts, will be too supportive for real estate sector.
Do you like the automotive story, especially the EV story, or are there risks and challenges there? We were speaking earlier to Crystal Intelligence. We were talking about the challenges associated with the rare earth minerals supply and the supply chain, and how that could disrupt production amongst the automotive manufacturers. Do you feel that that's the case, or is this a challenge that they can take in their stride?
No, that has emerged as a new bargain point, which we have seen between the US-China trade deal also. And it has not just impacted US automakers, it has impacted automakers globally. So for right now, 6 months, we know as a fact that the rare earth magnets and all will be exported and will be given to all nations. But yeah, that will be a concerning point if you don't have your prowess in that. That's your concern number one. Besides that, there are micro challenges also in India, where if you will start seeing seeing post the deal with the US if we start getting competition from EVs manufacturers from outside. So it will definitely lead to a competition. Price points will get disrupted overall. And remember, like number of cars per household have risen post-COVID over there. So taking that factors into account, we believe auto sector remain challenged. And when I said we like consumer, we like staples, we like discretionary, but ex-auto, we still remain underweight on auto sector in India.